Shocking, unprecedented, game-changing. Bitcoin's legendary 4-year cycle, the cornerstone of crypto investing, may have just been shattered. What does this mean for the market, and how will it impact your investments? Let's watch how the Bitcoin 4-year cycle just broke. Stay with us until the end to discover actionable strategies to navigate this unprecedented era. What exactly is the Bitcoin halving cycle? Why was this 4-year cycle once the holy grail for crypto traders? Let's start at the beginning because understanding the halving cycle is key to understanding why its breakdown is so shocking. The Bitcoin halving is a coded event that happens roughly every 4 years, cutting the rewards miners receive by half. This means that the number of new Bitcoins created, the new supply, suddenly drops by 50%. In simple terms, less new Bitcoin enters the market, supply tightens, and if demand remains steady or rises, the price should theoretically surge. Here's how it used to work. In 2012, Bitcoin's block reward dropped from 50 BTC to 25 BTC. In 2016, it dropped again to 12.5 BTC. Then in 2020, it halved to 6.25 BTC. And just recently, in April 2024, it dropped further to 3.125 BTC. Every time this happened, Bitcoin's price exploded in what seemed like a predictable 4-year pattern. After the 2012 halving, Bitcoin jumped from $12 to over $1,200 in about a year. After 2016, it surged from around $650 to nearly $20,000 within 17 months. Then post-2020 halving, Bitcoin's price rocketed from roughly $8,700 to nearly $69,000 in just 18 months. If you followed this cycle, buying before the halving and selling about 18 months after, you would have made a fortune. So, what has changed? Why is this cycle breaking down? Could the very forces that once powered Bitcoin's rise now be losing their strength? Here's the shocker. The halving cycle's power is fading and the impact it once had is shrinking fast. Why? Because the supply dynamic is changing. Think about it. Bitcoin's total supply is capped at 21 million coins. As of now, about 20 million are already mined, leaving only around 1 million left to be mined. That's less than 5% of the total supply. When the halving began, newly mined Bitcoin made up a huge percentage of the total market. In 2012, new supply accounted for about 25% of all Bitcoin in circulation. That's a massive influx, creating a significant supply shock every halving. Fast forward to today, and that new supply represents less than 1% of the total market. Here's a clearer picture. In 2012, miners produced 7,200 BTC per day at a price of about $12, which was a $32 million injection per year into a $130 million market, roughly 25%. By 2016, daily mining fell to 3,600 BTC with a $650 price, totaling $850 million annually, about 8% of the market. In 2020, mining dropped to 1,800 BTC per day at $8,700 or $5.7 billion annually, around 3.6%. Now, post-2024 halving, miners produced just 450 BTC daily, even at $95,000 per BTC. That's only 0.83% of a nearly $2 trillion market. Put simply, the supply shock caused by halving is barely making a ripple now. What about the Bitcoin already mined? Where is it all? Is Bitcoin's supply disappearing off the market? And if so, why? Here's another twist in the tale. A significant amount of Bitcoin is no longer available for trading at all. Estimates suggest about 4 million BTC are lost forever, wallets with lost private keys or destroyed devices. These coins are essentially off the market permanently. On top of that, a huge chunk of Bitcoin is now held by major players who aren't selling. Companies like MicroStrategy have bought and locked away over 500,000 BTC. They treat Bitcoin as a long-term reserve asset, not something to flip for quick profits. Other heavy hitters like 21 Capital, backed by big names like SoftBank and Tether, are piling in with tens of thousands of Bitcoin. Some institutional players are planning to lock away as much as 10% or more of total Bitcoin supply in corporate treasuries, then add government holdings. The US government alone controls over 200,000 BTC, primarily seized in various legal cases, and these coins are unlikely to flood the market. All this means roughly 30% of Bitcoin is effectively off the table, removed from active circulation. If not halving, then what's moving Bitcoin's price? If the old cycle is broken, what should traders be watching now? Here's the million-dollar question. If halving isn't triggering the explosive bull runs anymore, what is? The answer lies in liquidity and institutional adoption. Since around 2021, Bitcoin has increasingly mirrored the behavior of traditional financial markets, reacting strongly to macroeconomic factors such as interest rates, inflation, and overall money supply, especially the global M2 money supply, a broad measure of liquid assets in the economy. Before 2024, Bitcoin's price moved largely independent of money supply changes. But since the introduction of Bitcoin ETFs, exchange-traded funds, and massive institutional inflows, Bitcoin has started to move almost in sync with liquidity. When global money supply expands, Bitcoin tends to rally. When liquidity contracts, Bitcoin pulls back. This is a critical shift. It shows Bitcoin is now behaving less like a speculative gamble and more like a mainstream risk asset, similar to tech stocks. How institutional players are changing the game. Are big money managers rewriting the Bitcoin playbook? The institutional wave is not just theory, it's real and growing. Companies like MicroStrategy have billions of dollars in buying power, with plans to raise even more capital to add to their Bitcoin stash. Many institutions are following suit, treating Bitcoin as a treasury reserve, similar to how companies hold cash or gold. Wall Street's approach to Bitcoin is now largely risk-based. They shift capital between risk-on and risk-off modes depending on market conditions. When interest rates drop and inflation looks manageable, they're more likely to buy Bitcoin and other risk assets. When uncertainty rises, they pull back. Bitcoin's correlation with the S&P 500 has grown stronger, showing it's behaving more like a traditional risk asset than a unique digital currency responding solely to halving events. What does this mean for traders? Are you still relying on the halving calendar to time your trades? Beware. If you're still trading Bitcoin like it's 2017, relying on the halving countdown to time your buy and sell points, you might be setting yourself up for a big loss. The old formula of buy before halving, sell 18 months later is losing its predictive power. Instead, traders need to pay attention to broader macroeconomic signals. Watch global liquidity trends. Is money flowing freely or tightening? Follow institutional ETF flows and treasury allocations. Keep an eye on interest rates, inflation data, and overall market risk sentiment. These factors now having much bigger impact on Bitcoin's price than the mining supply reductions. Bitcoin is growing up. A new asset class emerges. Could Bitcoin be evolving from wild crypto roller coaster into a mature investment vehicle? This shift isn't just about price action, it's about Bitcoin's very nature. Since 2021, Bitcoin's volatility has dropped significantly. It used to swing wildly, with price swings of 80 to 100% over 6 months being common. Now those swings have dropped to around 55 to 60%, comparable to major tech stocks like NVIDIA. Bitcoin's beta, a measure of its sensitivity to market moves, is also declining. While it still acts like a risk-on asset, it's less reactive to every twitch in the stock market. It's beginning to chart its own course. Some experts believe Bitcoin is becoming a hybrid asset, part tech stock, part digital gold. This is a monumental change from the wild speculative market of just a few years ago. The liquidity cycle, your new best friend for timing Bitcoin moves. If halving is old news, then how do you time your entries and exits now? Since Bitcoin's price now closely follows global liquidity trends, the key to trading successfully lies in understanding the money supply. Look at the global M2 money supply. When it expands, more capital is available for investments, including Bitcoin. This usually pushes Bitcoin prices higher. When liquidity tightens, Bitcoin often falls. We are currently in a phase where money supply is expanding again, which suggests a bullish environment for Bitcoin in the coming months and years. Smart traders are now watching these liquidity signals more than halving dates. What's the takeaway for you? Are you ready to adapt or get left behind? Bitcoin's legendary 4-year halving cycle, once a surefire playbook for gains, has lost its power. The supply shocks that powered previous bull runs are no longer significant enough to move markets. Do you think Bitcoin's cycle is truly broken, or are we witnessing a temporary anomaly? How will this shift shape the future of crypto markets? Share your thoughts in the comments below. Don't forget to like, share, and subscribe for more in-depth analysis and updates on crypto's evolving landscape. Thanks for watching, stay curious, stay informed, and let's navigate this new era of crypto together.